Good morning and happy Thursday, everybody. Today is April 20th, 2023. And big story this morning, Philly Fed Manufacturing Index just came out. It's one of those obscure data points that the Fed releases from their many regional offices, and it showed a big contraction in manufacturing in the Philadelphia area. But it's the granularity in that report. It's where was the decline coming from that's got my attention this morning, because the big decline, the contributing factor that sent the index so deeply negative this month, was prices paid, the cost of the materials that these goods are manufactured from. It was still rising, but it's rising only barely, way down from where it was a month ago. This tells me that deflation is coming, and it's coming fast. I know a lot of you folks are struggling with the cost of living on the rise, and the cost of living is still rising. I want to emphasize that point. The cost of the things that you buy on a daily basis are still going up. But they're going up slower. They're going up a lot slower. It's slowing down very fast. And we're starting to see the early signs of deflation, that the inflation may not stop going up and it may go negative. That might be great for the average person's monthly budget, but that's very bad for, say, a Blackstone that has a $1 trillion portfolio full of commercial real estate and all kinds of other assets, that their prices would fall in that environment. And that's why this Philly Fed number is very important. Also, keep in mind, the Federal Reserve is widely considered to be on the brink of making another rate hike in May, another 25 basis point hike. Well, if we're on the brink of deflation, then hiking interest rates is the worst thing you could possibly do, because that raises the price of money just as money is about to become scarce. So that could be a huge policy mistake that the Fed is about to make in May. A lot of people think the Fed made a mistake with their last rate hike, so another one would be even worse. And another thing we're starting to see that tells me, deflation may be on the way, is we got another uptick in initial jobless claims this morning, and continuing claims continues to rise. That means rises in unemployment are on the horizon. Again, very deflationary. So with that, we are going to shrink my big melon of a head, and let's see what's going on in markets this morning. We have got the S&P 500 is down 30 points, or 0.7%, at 4,125. The Dow is down 158 points to start the day, down about 0.5% at 33,738. And the NASDAQ leading the way lower, down almost 100 points, or 95.78% lower at 12,062. And check out the DXY this morning, all over the place. We had a big spike in the DXY. It started around 7:30 a.m., and then as soon as that jobless claims and that Philly Fed number came out, we had a big step change down in the DXY, currently down 15 basis points at 101.82. Looking over at the bond market, we've got yields are down across the whole curve today. Looks like they're down more towards the middle or long end of the curve. We've got the 10 years at 3.54%, down 6 basis points, or about 1.5%. The 2-year is at 4.17%, down about 9 basis points, or 2%. Now, here's the big thing I want to draw your attention to. Look at the difference between the 1-month and the 3-month U.S. government bond yield right now. A 1-month Treasury is yielding 3.57%, but a 3-month is yielding 5.12%. Well, what gives? The overnight rate, the Fed funds rate, is 4.75 right now. Why is a 1-month Treasury yielding 3.57% when the 3-month is as high as 5.12? What happens in 3 months that has everybody so worried that you need to charge a higher risk premium to loan money for 3 months than you do for 1 month? Well, my opinion, that's the bond market telling us that the debt ceiling is a very real threat right now. You've got people are piling into short-term treasuries. We saw a lot of people are pulling their money out of savings accounts because the banks aren't paying anything in savings, and they're going into money markets. They're going into short-dated treasuries. Well, nobody wants to be caught holding treasuries if the debt ceiling pops. And so we've got right now people are piling into 1-month treasuries, which is bidding up the price of those treasuries and bidding down the yield on them. And then all of a sudden you get to the 3-month, you've got a big step change up in the yield because nobody wants to be holding these treasuries through the debt ceiling. That's bond investors telling us that, hey, maybe this idea that they're just going to rubber stamp the debt ceiling, it's not so cut and dry. I've talked about it on other live streams in the past, how leadership in Congress is at the worst state in years, and that's a bold freaking statement right there, folks. And we've also got the fact that, tax receipts are coming in right now. It's a good bet they're going to come in lower than a year ago, so we may not have as much time as we think to get the debt ceiling done. We'll know about that in the next couple of days when we get more data points from the Treasury General account. But keep your eye on that 1 month and 3 month spread between the U.S. Treasuries. That's telling us that there's a very real threat of something happening with the debt ceiling, folks. Looking over at commodities right now, we've got gold is up $10 this morning, 0.5% at 2017. Still staying above that 2000 mark. And silver is at 25.45, up about 8 cents this morning, or 1/3%. Also still above that important 25 threshold. Crude oil is at 77.78. That's West Texas Intermediate, down another $1.40 this morning, or 1.8%. And natural gas is down about a penny at 2.21. All right, here's the big story right now. Philly Fed Manufacturing Index. This is on tradingeconomics.com. The Philly Fed Manufacturing Index fell to negative 31.3 in April. That's the lowest reading since May of 2020, and it's down from 23.2 in March. Now, the important thing to remember here is that these indexes, anything above zero means manufacturing is expanding. Anything below zero means it's contracting. And this means we are in deeply, deeply into contracting territory. You can kind of see on the chart here, we started contracting really about early last year, maybe early summer, and we've gotten worse and worse. But this is a big step change down here at negative 31.3. Now, this is the 8th consecutive negative reading. The survey's broad indicators for activity remain negative, although the indexes for new orders and shipments rose. That's interesting. We did see a rise in new orders in the New York Manufacturing Index also. The employment index suggests steady employment overall, so that's not the source of the big decline. Both price indexes continued to decline. The future indicators suggest the firm's expectation for growth over the next 6 months remains subdued. And this is the important thing right here. Both price indexes continued to decline. That's the source of this big decline in the Philly Fed Manufacturing Index, and that's what has me saying deflation is coming. And check out this one right here. This is the prices paid index. This is one of the components that makes up the Philly Fed Index. And you can see here we had a big step change down from 23.5 all the way down to 8.2 with this reading. Again, anything above zero means it's expanding. Anything below zero means it's contracting. So prices are still rising. This is prices paid. This is the price for the raw materials to manufacture the goods. So they're still rising at 8.2%. I want to clarify that. We still have inflation, but just barely. It was 23.5 a month ago. Now it's just barely rising. That's telling me inflation is falling. It's falling fast, and it doesn't mean it's going to stop when it gets to zero. It could go all the way down into negative territory. And deflation, if you're a stockholder, if you own real estate, if you own gold, if you own Bitcoin, if you own any asset class, deflation is very bad for your bottom line because it hits assets first. Also, it's not just prices paid that's shrinking, right? And prices paid, it fell hard from 23.5 down to 8.2. Check out this tweet from Robert Burgess on Twitter. Deflation, the prices received portion of the Philly Fed's monthly index fell below zero for the first time since the start of the pandemic lockdowns. And here's the chart that Mr. Burgess is showing here. You can see it all the way down here, below zero, just barely in negative territory. That's prices received, the money they're getting paid for their goods. It's negative for the first time since the height of the pandemic lockdowns. Now look, folks, prices received, negative. Prices paid, still barely positive. What does that tell you about the margins for the people who are manufacturing things in the Philly region? Those margins are getting squeezed. That is very bad for anybody who makes things in the United States. Margins getting squeezed, deflation on the horizon. This is a very bad sign for the U.S. economy, folks. Also, we got in today initial jobless claims, another bad indicator for the economy, another indicator that tells me the Fed is about to make a big policy mistake. The number of Americans filing for unemployment benefits rose by 5,000 to 245,000 for the week ending April 15th, the most in 1 month and above market expectations of 240,000. The result was in line with a batch of data, yada, yada. We don't need to get into that. But here we can see in this chart, initial jobless claims is on the rise. It's still ticking up. We had a step change a couple of weeks ago, and it's staying higher. Remember, we did that live stream a few weeks ago where there was that massive revision to all the prior data, and all of a sudden all the jobless numbers ticked up. Well, they ticked up higher, and they have stayed higher. And what's worse is the continuing claims continues to get worse. Not only are the initial claims on the rise, but these people are not finding work easily. Continuing jobless claims in the U.S., which measures unemployed people who have been receiving unemployment benefits for a while, rose to 1.865 million in the week ending April, up from a revised 1.804 million a week before, and well above market expectations for 1.82 million. This is the highest level since November 27th, 2021. And you can see here it started really last fall. The continuing jobless claims began to rise, and they have been rising ever since. So we've got these increases in initial claims of about 245,000 people, and we've got about 65,000 more people are now filing continuing claims. That means that as people lose their jobs, about a quarter of the people who lose their jobs are not able to find new jobs right now. That means this continuing claims number is going to keep rising. That means about every 3 to 4 weeks, we're looking at a 0.1% increase in unemployment if this trend continues. Look, this trend goes all the way back to September. I have no reason to suspect this trend might stop. Actually, I have plenty of reasons to think this trend might accelerate. Remember, we were talking a few days ago about how U.S. auto sales, that subprime auto lender, that they're going out of business. Why? Because they can't access the debt market, because banks are tightening credit conditions. They're playing defense. They're not making risky loans. And so if people who are dependent on those risky loans can't access the capital, they go out of business. Their employees go on unemployment. So in the aftermath of this banking crisis, with credit conditions tightening, I expect we're going to see bigger spikes in initial jobless claims, and we're going to see more of those initial jobless claims are not able to find new work, and so the continuing claims will continue rising, which will lead to higher unemployment. Elsewhere in the markets right now, we've got this one came up. Blackstone profit slides as deal making hit by market tumult. I love that word, tumult. Pace of sales and new deals slows during the first quarter. Blackstone Inc.'s first quarter profit fell as deal making at the world's largest alternative asset manager slowed in a tumultuous stretch when rising interest rates roiled markets. Distributable earnings fell 36% from a year earlier. Not a small downtick in earnings for Blackstone. 36% fall in earnings. And look, I've been talking about Blackstone a lot on this channel. They are one of the biggest holders of commercial real estate in the world. And let's just say I don't think there are good things on the horizon for Blackstone, all things being equal. Where else? I wanted to talk about this one. Where are you guys? Man, I lost my place. Bear with me, folks. Here we go. Assets under management edged closer to the $1 trillion mark, rising 8% to $931 billion. All right, so here's the thing about assets under management for BlackRock. BlackRock is one of the largest holders of commercial real estate in the world. They've got their $70 billion B-REIT portfolio that I've talked all about, that they lock the doors because investors are not allowed to withdraw their cash from their portfolio. The investment is so good, we'll never let you sell it. So that's $70 billion of their $1 trillion in assets under management that they won't even let people sell it. And then they just raised another $30 billion from teachers' pension plans. I did a video about that last week in order to provide exit liquidity for a lot of these banks with the commercial real estate bubble that is about to collapse. So about $100 billion of this $1 trillion in assets under management at Blackstone is commercial real estate that's not worth anywhere near what Blackstone claims it's worth. If they actually mark this stuff to market, which is very hard to do with an office building, it wouldn't be worth anywhere near what they're claiming. So keep an eye on Blackstone. Something tells me these guys are going to be making big headlines in the weeks and months to come. So long story short, folks, the Philly Fed numbers, very bad. It shows very bad conditions for manufacturing in the U.S., and it's getting worse. And if the Fed raises interest rates, it would be a colossal policy mistake because raising rates into deflation is not where you want to be. And I just have to send a shout out to, where are you? Mr. Peter Frowen. Thank you, Peter, for the super chat and the support of the channel. Peter says, keep up the great work, Jack. Thank you. I shall strive to do so, Peter. Thank you very much for the support of the channel and for the kind words. I love this job. I want to do it forever and ever. And thank you to Jake's Custom Parts says platinum is quietly climbing. Two things you got to watch in platinum, Jake. All right, there's two forces at play in platinum, and I'm not sure which is the bigger force there. First of all, you've got supply. Platinum is vulnerable to the manipulation of paper markets the same way gold and silver is, even more so because platinum is a much less liquid market, which means if the banks start playing games in platinum markets, they could have a bigger effect on price by papering over the market. Now, that being said, the supply is very tight of platinum. So if they do play their paper games, it's a riskier game for the banks to play because they will run out of physical metal sooner if they try that. And if the traders call their bluff and stand for delivery, they'll run out of metal very soon. The other thing you have to worry about in platinum markets is these power outages in South Africa are a very big deal. The power grid in South Africa is wonky at best, on the brink of failure at worst. And 80% of the platinum in the world comes from South Africa, folks. It's mined in South Africa. So if the power grid just fails outright, if it continues to deteriorate in South Africa, it's going to affect the mines. Their production will be affected. And even if the mines have generators, even if there's things you can do locally to help things, it's going to slow everything down in the country. It's going to slow down transportation. It's going to slow down the ports and the refiners. So it's definitely going to affect the platinum supply. So you have to keep an eye on that. Now, the other thing you got to worry about with platinum is the auto market right now. Nobody can afford a new car. Keep in mind that story about U.S. auto sales. Keep in mind the story about, American Car Center. All these subprime auto lenders are going out of business. The market for cars is shrinking right now because people just can't afford them. They just can't afford a car, right? And these clowns over at the World Economic Forum are over in the corner saying, excellent, because that's what they want. They want the poor people to stop driving to save their climate goals. They don't care what it means for poor people's lives, but it's a fact that cars are becoming unaffordable. Well, the main demand for platinum is for catalytic converters and internal combustion engines. So that's another factor you have to consider. So you've got a tight supply. You've got a supply that's at risk because of South Africa's power grid, but at the same time, you've got crooks in charge of the platinum market, and you've got uncertainty of demand for platinum because of the auto industry. I don't know which one of those forces is going to prevail and where it's going to take platinum markets. All right. So full disclosure, I own a little bit of PLTM. It's an ETF that tracks the price of platinum. I don't hold any physical platinum or anything like that. But there's a lot going on in platinum markets. And you're right. I think it's probably going to be in the news quite a bit in the weeks and months to come. And I think I got everybody. I did. Thank you very much for your super chats, guys. I appreciate the support of the channel. Thank you to my Patreon supporters. I enjoyed talking to you guys yesterday. Link down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.